Welcome to Pro News Weekly. Let's examine the latest news on the financial markets. The dollar is sliding down again, stock indices are hitting new highs, gold is in retreat, and Bitcoin has been on a roller coaster ride. The conflict in the Middle East has restored the US dollar's status as a safe haven asset, and that has been its downfall. The inverse correlation with US stock indices, amid growing global risk appetite, has caused the USD index to hit 3-year lows. Investors perceive the ceasefire as the end of the 12-day war between Israel and Iran and are buying stocks. Carry traders are actively using the US dollar as a funding currency. Since the beginning of the year, its effectiveness in arbitrage against a basket of emerging market currencies has exceeded 8%. The use of the yen in carry trades has yielded just over 2%, while the euro and Swiss franc have been unprofitable. The weakening of the US dollar is part of the White House's plans. Donald Trump is putting pressure on the central bank to lower rates by 2 to 2.5 percentage points. The president intends to name Jerome Powell's successor ahead of schedule, as early as this autumn. The emergence of a shadow Fed chair will put pressure on the USD index. The de-escalation of the conflict in the Middle East brought the S&P 500 closer to record highs. A new wave of interest in artificial intelligence has allowed the Nasdaq 100 to update its historical peaks. The growth of US stock indices at the end of June is being called a rally of tech giants. Nvidia has surpassed Microsoft in terms of market capitalization, again becoming the most expensive company in the world. Support from the White House is creating a tailwind for US stocks. However, the market is overly confident about Donald Trump's intention to extend the 90-day delay in import duties or to limit himself to a minimum universal tariff of 10%. The US president has repeatedly emphasized that his policies have brought billions of dollars into the budget. His chief economist, Steven Mnuchin, has estimated the inflow of money from tariffs at $3 to $5 trillion over 10 years. As the expiry date approaches, fear may return to the markets. The inflated fundamental valuations of the S&P 500 are causing concern. The price-to-earnings ratio exceeds 22. This is 35% higher than the historical average for the indicator. The truce between Israel and Iran has reduced demand for gold as a safe haven asset. The precious metal has been unable to break out of the medium-term consolidation range of $3,100 to $3,400 per ounce and resume its upward trend. This is a sign of weakness among bulls and allows Citigroup to predict a fall in prices below $3,000 in 2026. According to the company, thanks to Donald Trump's grand and attractive tax reduction project, the acceleration of the U.S. economy will send gold quotes down. The decline in geopolitical risks will add fuel to the fire of gold's fall. Goldman Sachs, on the other hand, maintains its forecast for the precious metal to rise to $4,000 per ounce. It cites the insatiable appetite of central banks, the weakening of the dollar, and the fall in U.S. Treasury bond yields. Indeed, the White House is interested in lower debt market rates and a weaker currency. According to the latest World Gold Council survey, 43% of central banks plan to increase their purchases of bullion over the next 12 months. This is a record high. A year ago, the figure was 29%. Bitcoin took advantage of the conflict in the Middle East and was bought up during the slump. Geopolitics is rarely a long-term factor. As a rule, investors eventually get used to wars and other geopolitical shocks. The crypto market feared that Iran, deprived of the opportunity to export oil, could raise money by selling digital assets. Fears about an increase in their supply pushed Bitcoin quotes down. In fact, everything turned out to be not as bad as expected. The armed conflict between Jerusalem and Tehran lasted 12 days. The ceasefire announced by Donald Trump had a positive effect on the U.S. stock market. U.S. stock indices are setting new records or preparing to renew historical highs. At the same time, improved global risk appetite is pushing Bitcoin higher. The cryptocurrency is supported by a $131 billion inflow of capital into ETFs since the launch of specialized exchange-traded funds in January 2024, and growing interest from institutional investors. The consolidation of Bitcoin above 105,000 increases the risks of a resumption of the upward trend. As June turns to July, investors' attention will shift from geopolitics to trade wars. The expiration date of the White House's 90-day tariff delay is approaching. Countries are rushing to conclude trade agreements with the U.S. to limit themselves to a universal tariff of 10%. The European Union is also rushing. However, Brussels is ready to impose retaliatory duties on imports worth $116 billion if negotiations with Washington are unsuccessful. The escalation of trade wars could restore the direct correlation between the dollar and U.S. stock indices. The greenback is used as a safe haven currency when the epicenter of turmoil is outside the United States. When the threat comes from the White House, investors prefer to sell American assets such as the S&P 500 and the USD index. The economic calendar features releases of German and European inflation data, a speech by Christine Lagarde, and statistics on U.S. business activity and the labor market. According to Chief Economist Philip Lane, the ECB's cycle of monetary easing is coming to an end. Markets are expecting just one more 25 basis point cut by the end of 2025. Derivatives are pricing the Fed's 66-point cut. Divergence in monetary policy is the key driver of the Euro-USD rally and the decline in the USD index. Follow the latest developments on global markets in Pro News Weekly. Like, share, and subscribe.